Cryptocurrency is a digital payment system that doesn't rely on banks to verify transactions. It's a peer-to-peer system that can enable anyone anywhere to send and receive payments. Instead of being physical money carried around and exchanged in the real world, cryptocurrency payments exist purely as digital entries to an online database which is stored in digital wallets. Cryptocurrency received its name because it uses encryption to verify transactions. This means advanced coding is involved in storing and transmitting cryptocurrency data between wallets and to public ledgers. The aim of encryption is to provide security and safety. The first cryptocurrency was Bitcoin, which was founded in 2009 and remains the best known today. Cryptocurrencies run on a distributed public ledger called blockchain, basically a record of all transactions updated and held by currency holders. Units of cryptocurrency are created through a process called mining, which involves using a computer power to solve complicated mathematical problems that generate coins. Users can also buy the currencies from brokers, then store and spend them using cryptographic wallets. If you own cryptocurrency, you don't own anything tangible. What you own is a key that allows you to move a record or a unit of measure from one person to another without a trusted third party. Although Bitcoin has been around since 2009, cryptocurrencies and applications of blockchain technology are still emerging in financial terms, and more uses are expected in the future. Transactions including bond, stocks, and other financial assets could eventually be traded using the technology. Certainly, high-profile people and politicians such as Donald Trump and Elon Musk are pushing for this. There are thousands of cryptocurrencies. Here are a few: Bitcoin, Ethereum, Litecoin, Ripple. Non-Bitcoin cryptocurrencies are collectively known as altcoins, to distinguish them from the original. You may be wondering how to buy cryptocurrency safely. There are typically 3 steps involved. 1. Choosing a platform. 2. Funding your account. And 3. Placing an order. Step 1. Choosing a platform. The first step is deciding which platform to use. Generally, you can choose between a traditional broker or a dedicated cryptocurrency exchange. Traditional brokers are online brokers who offer ways to buy and sell cryptocurrency, as well as other financial assets like stocks and bonds. These platforms tend to offer lower trading costs, but fewer crypto features. Then there's cryptocurrency exchanges. There are many cryptocurrency exchanges to choose from, each offering different cryptocurrencies, wallet storage, interest-bearing account options, and more. Many exchanges charge asset-based fees. When comparing different platforms, consider which cryptocurrencies are on offer, what fees they charge, their security features, storage and withdrawal options, and any educational resources. Step 2. Funding your account. Once you have chosen your platform, the next step is to fund your account so you can begin trading. Most crypto exchanges allow users to purchase crypto using the US dollar, the British pound, or the euro using their debit or credit cards, although this varies by platform. Crypto purchases with credit cards are considered risky, and some exchanges don't support them. Some credit card companies don't allow crypto transactions either. This is because cryptocurrencies are highly volatile, and it is not advisable to risk going into debt or potentially paying high credit card transaction fees for certain assets. An important factor to consider is fees. These include potential deposit and withdrawal transaction fees plus trading fees. Fees will vary by payment method and platform, which is something you should research beforehand. Step 3. Placing an order. You can place an order via your broker's or exchange's web or mobile platform. There are also other ways to invest in crypto. These include payment services like PayPal and Cash App, which allow users to buy, sell, or hold cryptocurrencies. Once you have purchased cryptocurrency, you need to store it safely to protect it from hacks or theft. Usually, cryptocurrency is stored in crypto wallets, which are physical devices or online software used to store the private keys to your cryptocurrencies securely. Some exchanges provide wallet services, making it easy for you to store directly through the platform. However, not all exchanges or brokers automatically provide wallet services for you. There are different wallet providers to choose from. The terms hot wallet and cold wallet are used. Hot wallets refer to crypto storage that uses online software to protect the private keys to your assets. Cold wallet storage, unlike hot wallets, rely on offline electronic devices to securely store your private keys. Typically, cold wallets tend to charge fees, while hot wallets don't. When it was first launched, Bitcoin was intended to be a medium for daily transactions, making it possible to buy everything from a cup of coffee to a computer or even big-ticket items like real estate. That hasn't quite materialized, and while the number of institutions accepting cryptocurrencies is growing, large transactions involving it are rare. Even so, it is possible to buy a wide variety of products from e-commerce websites using crypto. Here are some examples. Several companies that sell tech products accept crypto on their websites, such as AT&T and Microsoft. In April 2021, Swiss insurer AXA announced that it had begun accepting Bitcoin as a mode of payment for all its lines of insurance except life insurance due to regulatory issues. If you want to spend cryptocurrency at a retailer that doesn't accept it directly, you can use a cryptocurrency debit card such as BitPay in the US. Quick one. If you're enjoying this video or finding it informative, please do hit the like button, share and subscribe if you haven't done so, as this really encourages the channel to grow and help build our community. Please also leave a comment below to let me know what you think of this video. Thanks! Unfortunately, cryptocurrency crime is on the rise. Cryptocurrency scams include fake websites which feature fake testimonials and crypto jargon promising massive guaranteed returns provided you keep investing. Virtual Ponzi schemes where cryptocurrency criminals promote non-existent opportunities to invest in digital currencies and create the illusion of huge returns by paying off old investors with new investors' money. One scam operation, BitClub Network, raised more than $700 million before its perpetrators were indicted in December 2019. Celebrity endorsements can include scammers posing online as billionaires or well-known names who promise to multiply your investment in a virtual currency, but instead steal what you send. They may also use messaging apps or chat rooms to start rumors that a famous business person is backing a specific cryptocurrency. Cryptocurrencies are usually built using blockchain technology. Blockchain describes the way transactions are recorded into blocks and time-stamped. It's a fairly complex technical process, but the result is a digital ledger of cryptocurrency transactions that's hard for hackers to tamper with. In addition, transactions require a two-factor authentication process. For instance, you might be asked to enter your username and password to start a transaction. Then, you might have to enter an authentication code sent via text to your personal cell phone. While securities are in place, that does not mean cryptocurrencies are unhackable. At this point in time, be very careful when trading with crypto. Now, we're all about tech focus on this channel. If you're curious as to where deleted photos go on your phone, then this is the video for you.